personal finance practice problem using OneNote. High short-term loan rates annualized. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, down in the 4120 High Short-Term Loan Rates Annualized tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at payday type loans, loans that are typically of a short dollar amount and they're short in terms of time frame, typically less than a year. Because of that, you may see the payday loans then being represented as either simply a dollar amount or with an interest rate that's going to be something other than an annualized rate. When you see that, then typically what you want to do is try to annualize the rate because you can get a better idea of the interest rate when you do that. In other words, when we see interest rates, remember that normally an interest rate means an annual rate unless it's stated otherwise. So even if you have some long-term loan you're dealing with, like a mortgage or like a car loan, which we know we pay off monthly, if they give you a rate like this rate, 4.25 or something like that, unless they say otherwise, usually that's going to be the annual rate, the yearly rate, which we then have to break down to a monthly rate if we want to do some calculations with regards to a typical loan that we pay off on a monthly basis. Now, it's possible to represent rates for the period that is being covered. If that is the case, that's not something that our brain is as used to. So typically what we would want to do is annualize it so that we can put it into context and get a better grasp of what the rate means to us. We don't have a conceptual knowledge, for example, here of what a 4.25 rate means for a 4-week loan, because we don't usually think of rates in terms of a 4-week time period. We think of rates in terms of a year time period, in part because normally that's going to fall in the rate being somewhere between 0 and 100%, usually if it's a yearly rate. And if you're doing something like a monthly rate or a 4-week rate, usually it's going to be something quite small, meaning it'll be less than 4%. And that's one reason we use the convention of in essence, talking about yearly rates generally. Now, note when you're looking at these small loans, if you're looking at small dollar amount loans and loans that are for a small period of time, you can see that it makes sense that you're going to have a higher or increase in the amount of the cost of the loan for multiple reasons. One, just the paperwork to make a loan that's going to be, less than $1,000 or something like that is going to be substantial compared to the loan, processing cost. And there's usually going to be a high amount of non-payment of those kinds of loans. And therefore, if you're in the business of these types of loans and there's a high default rate, people not paying back the loan, the way you cover that is to have higher, basically, interest rates. So note, when you look at these loans, they're also going to be regulations with regards to these loans and whatnot because of the high rates, which there can be debate over whether or not it's a good idea or what's the best approach to regulate these types of loans. So let's kind of think about it. We'll say here that you might see a loan, for example, that's represented just in a dollar amount. They might say something like, we'll give you a $400 loan for a 4-week time period with a cost of $60, right? So you're going to say, all right, well, if I got to pay back $60 divided by a $400 loan, then that would be a 15%. But the problem is that that's for a 4-week time period, and that's not normally what we deal with loans for. We deal with them on an annual basis. So typically what you would want to do to compare it to other loans is annualize it. And that's going to be one of the concerns. So here, let's say we came out with a payday loan charges for a 4-week loan of 4.25. So if we get a percent of 4.25 for a 4-week time period, or if we did our basically cost division problem here and came out to 4.25, then the next step is, well, how can I annualize that? And so I can compare it to what the normal kind of loan components are. We can do that without even having a loan amount, and then we'll pick a loan amount and think of it with a loan amount, which can make these problems a little bit more concrete. So if we had the interest rate per period is 4.25 for a 4-week period, we're going to say it's for a 4-week period, that 4.25. So we're paying 4.25 just on that period. Then we can look at the periods per year, and I'm going to do this. We're going to estimate 52 weeks in a year. Remember, whenever you do these estimates in terms of how many periods are in a year, you could try to round this so that the months are kind of even, or you could try to be more exact because there's around 365 days in a year. But if you try to make the months equal proportion, which can make it easier to calculate some things, you'd be 12 times 30. We'd say 30 days in each month would be 360. And if we look at the number of weeks in a month, if we take that 360 divided by 7, we get about 52. Or if we take, in other words, 365 divided by 7 days. I'm sorry, let's do that one more time. We're going to say take the 365 divided by 7, and that's going to give us about 52. So we're going to use about 52 weeks, and that's a number that you might just want to memorize. There's about 52 weeks in a year. Obviously, we have leap years and whatnot and some unevenness, but we're going to use around 52 weeks in the year. So the loan period in weeks is 4. So we had 4 weeks of the loan, and so we have 52 days in the year. So how many pay periods will that cover? We could say 52 divided by 4 is going to give us 13. Now, another way you could try to do this, you could try to say, well, if there's 4 weeks, you could break it out into days, right? If you're more comfortable with that, or if they give you some other term that's like in a number of days or something like that, you could then take the 4 weeks times 7, saying a week is 7 days. We're going to say 28. And then you can compare that to the days in the year, which you could estimate as either 360, 12 times 30 if you want a nice round number, or 365, closer to the more exact number. So 28, if we took the 365 divided by 28, we're going to get around 13 because, once again, we have some rounding involved. So the point is that we got to take some ratio of the year, and that'll give the periods in the year. And then we can take the 4.25 times, let's do it this way, 0.0425 times the 13, and that's going to give us, if we move the decimal 2 places over, the 55.25%. So you get a very high rate here, and with relation to what you would normally see for a normal type of loan if you were taking a longer term loan time period that you're going to be taking out. So let's see that another way we can kind of calculate this. If, on the other hand, the way you normally get this for a longer term loan, you would get possibly the yearly rate, and then you'd have to break it down to the monthly rate when you do calculations. That would be the normal case if you were doing something like a car loan or a home loan. Oftentimes they'll give you the yearly rate, and then you'd need to break it down to the monthly rate for that time period. Let's do that kind of calculations just so we can see it going both ways, meaning if they gave us the yearly rate of the 55.25, and then we'd say, okay, well, if the yearly rate is 55.25 and I've got a 4-week loan, then how am I going to determine how much I pay on a 4-week basis if it's a 4-week loan? Well, then we would take that rate and we'd break it back down, and we're going to get back down to the 4.25 by saying we're going to take the 55.25 and then take the fraction of a year, which would be the 4 over the 52. So we'll do kind of the inverse of what we did before. 4 divided by 52 is going to give us about the 0.07693 and so on. And then we can take that times the 0.5525, and that'll give us the 4.25. So if we had a $100 loan, we could take the $100 and say, okay, we're going to pay the rate for that 4-week time period of 0.0425, and that would be 4.25. And you could see, even with this really high, fairly high interest rate here, we're only having to pay on this small loan for this four-week period 4.25, and that would be a fairly small amount just to process basically the loan. Plus, you have the high kind of default rate, so you can see why these kind of short-term loans end up having these high kind of rates, as opposed to longer-term loans, which you would think would be well more worth the institution processing the loan. Possibly if they have security, it would be a more secure loan, and so on and so forth. The other way you can kind of think about this is you might take the $100 times the yearly rate, which would be the 0.5525, and then break it down to the period that's being covered, which is the 4-week time period, by taking the fraction of a year. So you could take that and say, I'll divide it by the number of weeks in a year. So divided by 52, that would be the number of weeks in a year, and then times 4, and that would give us, once again, our 4.25. So let's think about this a couple other different ways. If we look at the interest per period, and now we take our $100 loan, and we were going to say that the interest per period is going to be that 4.25. That's the interest rate per 4-week time period for the period that's being covered. Then, of course, that would give us the $4.25 that would cost us, and that means the repayment of the loan would be $104.25. So again, even when you annualize this rate, you get a pretty high rate in comparison to other loans, and you can see that the actual cost to process the loan is still fairly low. And this is one of the reasons that you get this out of proportion kind of rate that's going to be involved here. And so you could use this kind of method to deceive people, and that's where the problem is, of course, when you use the rate for a smaller time period and you give someone a 4.25 rate. You could use that to try to deceive people in that they're usually thinking about yearly rates, which would be this big 55.25. But at the same time, you can also see that if you were just trying to communicate the loan, and you told someone they're going to pay 55.25 for a 4-week time period, they've got to do a little bit of math to get down to the actual 4.25 rate. So you can see, like, from just a logistical standpoint, if you were in the business of doing these kinds of loans and you had to hire, even if you're trying to make a modest profit margin because it's a for-profit business, and you had to charge a fairly high rate to cover the costs on these small loans in order to cover the processing cost, the fact that they're going to be high-risk loans, and that they're short-term kind of loans just to process the paperwork on them, then how would you communicate that? If you use the larger rate, it could be a little bit difficult to communicate. If you use the smaller rate, you could be deceiving people in that that's not what they're used to in terms of the yearly rate. And if you just give someone the dollar amount, again, people will say that that's a deceptive kind of strategy, because when you just look at the dollar amount, you're not comparing it to the rates, which usually when we compare rates, we annualize the rates. And that's why we do it. So notice there's a lot of pressure on these types of loans oftentimes to have regulations possibly regulating them out of the market, which there's debate on that too, because if you're in a situation where I need a loan that's less than $1,000 or something like that just to pay for an immediate need that I need to do now at this point in time, I would like to have some place where I could go where it's a legitimate for-profit regulated business operating under the law, as opposed to if they regulate those things out, meaning they can no longer make a profit because of regulations, and therefore there are no more of these kind of loan places out there, and I'm in that situation, then I have to go to like a pawn shop or to a black market type of situation, which I obviously there's no laws if you're going to someplace that's not a legitimate business in order to get a loan. And so to me, it would be better to judge these kind of places fairly. You can't just look at the percent, really. You got to look at what their profit margins are and what their advertising tactics are and who they're kind of advertising to, types of things. So it's an interesting kind of area. But in any case, we got the interest per period. Another way you can calculate this is you can take the loan of $100, and then you can take, and if I just want to get to the repayment amount, we could take the 0.0425 per period plus 1, and that would give us the 1.0425, and take that, which would be 104.25% about, and then multiply that times 100, and that would give us the 104.25. And we can also think about it a couple different ways, just to kind of think about this a few different ways. If we took the annual rate, if we took the $100 times the 55.25, this would be the amount if the $100 were held for the entire year. It's not. It's only a 4-week loan. But if it was for the entire year, we take the $100 times the 55.25%, that would cost us $55.25 for the entire year, which again would be quite significant if it was a year-long loan because you're paying back, over half of the loan amount. And then the repayment amount would be the $100 plus the 55.25 or the 155.25, which you can also calculate by taking that 0.5525 plus 1, which would be the 1.5525, and getting right to that end number by multiplying that times the 100, and that would give us our 155.25. One other way to look at this, just to see if sometimes this works, to look at it this way just to understand it a little bit better. If the interest for 4 weeks was the loan amount times the rate of the 4.25, this 4.25 representing the rate for the time period of the loan, which in this case is 4 weeks, that would give us the 4.25. And then the periods per year, the weeks per year are 52, and the loan period is going to be 4. So we're representing this in weeks, and that would give us then our 13. Remember, you could represent this in days if you wanted to do it that way, possibly being a little bit more exact, which would be 365 days. And if it's 4 weeks times 7 days in a week, we're talking 28 days. So we're looking 365 days in a year divided by 28, and that would give us around our 13 as well. And so then we got the interest per year. So we're going to say it's the 4.25 times the 13, meaning if we have this 4.25 times the number of periods in the year, which would be 13, notice that no compounding, that would be the 55.25. And then we'd have compare that to the loan amount. If we compare that 55.25 to the loan amount, 55.25 over the 100, we get to that 55.25%, which is our yearly rate. Another way to calculate the yearly rate we got to up top here. So there's just a few ways that we can kind of work this. Sometimes if you just mull it over a couple different ways, these kind of rates make more sense. The bottom line is that you typically want to be annualizing whatever kind of interest rates you get. So usually someone's going to give you an interest rate. If they give you a dollar amount, then typically you want to pick up the interest rate so you can figure it out. And then normally you want to pick up the interest rate on an annual basis. And normally, oftentimes, you're given the interest rate on an annual basis. If you're talking about other kinds of loans, typical loans like a mortgage or a car loan. And if you want to do some calculations like the payment calculations, you got to break it down, that rate down to whatever period's being covered, often in that case being monthly periods. So when you're looking at these kind of loans, you have these weird periods that could be covered as well, which is kind of confusing. A loan for, a week, or a loan for a couple weeks, or like 2 months or something like that. Those aren't standard times of loan periods that we're used to, which is usually more like, a series of months or years or so on. And that adds to confusion with, just communicating the loans. And anytime there's confusion with communicating something because it's complex, that leads to the ability for deception to be involved in it as well.